Investments today announced a strategic investment in LayerZero Labs, the development company behind interoperability protocol, reflecting its support for the development of proven, production-grade interoperability infrastructure used across the global digital asset ecosystem. Combined with the Wallet Development Kit, WDK, by Tether, this infrastructure provides the most advanced foundational rail for digital assets payments, settlements, and custody for real-world use cases, and is also perfected for agentic finance, allowing AI agents to operate their own autonomous wallets and frictionlessly transact with stablecoins and digital assets at scale. LayerZero Labs is the creator of one of the most widely adopted bridging frameworks in the market today, providing the underlying technology that enables digital assets to move securely and efficiently across blockchains. Over the past year, LayerZero's interoperability infrastructure has been leveraged by Everdawn Labs to develop and bring to market USDT0 and XAUT0, enabling large-scale cross-chain value movement under live market conditions. Built on LayerZero's omni-chain fungible token standard, these implementations demonstrated that stablecoins and tokenized assets can move seamlessly across blockchains without fragmentation or loss of liquidity. Since launch, USDT0 has facilitated more than $70 billion in cross-chain value transfer in under 12 months, serving as real-world proof of global-scale interoperability and validating LayerZero Labs technology as critical infrastructure supporting major assets. The investment reflects Tether's confidence in LayerZero Labs' engineering capabilities, execution track record, and its role in advancing interoperability as foundational infrastructure. It aligns with Tether's broader strategy of supporting systems that reduce fragmentation, improve liquidity efficiency, and enable stablecoins to function as global settlement instruments across multiple diverse blockchain environments. Tether Investments invests in infrastructure that is already delivering real-world utility, said Paulo Arduino, CEO of Tether. LayerZero Labs has built interoperability technology that allows digital assets to be transferred in real time across any transport layer and distributed ledger, enabling a fundamental utility within the financial industry. This enables digital assets to serve the infinite agentic AI economy that will require such primitives to orchestrate micropayments at an unprecedented scale. Tether is a company the world envies. They have turned a vision of borderless money into a reality, said Brian Pellegrino, CEO of LayerZero. The success of USDT0 was an important stepping stone. Having Tether deepen its commitment with this investment is the ultimate validation. We are thrilled to continue building the rails for global permissionless markets together. About Tether Investments is the independent investment arm of Tether, the largest company in the digital assets industry. Based in El Salvador, the firm deploys capital from Tether's profits and excess reserves across a wide range of sectors where technology, infrastructure, and real-world utility intersect. Its portfolio includes investments in artificial intelligence, financial services, energy, biotechnology, education, and digital media, as well as strategic stakes in industries such as commodities, remittances, and sports and entertainment. Tether Investments supports ventures with long-term potential to improve access, efficiency, and resilience in both emerging and developed markets. Its work supports Tether Group's broader mission to strengthen decentralized systems, promote infrastructure resilience, and expand real-world access to open, transparent technologies.
Global Energy News Overview on February 10, 2026. Oil and gas price dynamics, OPEC Plus decisions, LNG market, oil products and refineries, electricity, renewable energy, and coal. Summary and analysis for investors and market participants. The global energy sector at the beginning of 2026 demonstrates relative stability despite conflicting factors. Oil prices remain at moderate levels, while the market balances between a projected surplus in supply and ongoing geopolitical risks. Europe is experiencing volatility in the gas market amid low inventories and weather factors, while the energy transition accelerates. Renewable energy sources, RES, are hitting records in implementation, and coal has reached peak demand. Below are the key news and trends in the oil and gas sector and energy markets today. Global oil market, surplus and price stability. The oil market entered 2026 showing signs of excess supply. According to the IEA, a significant oil surplus of up to 4 million barrels per day, approximately 4% of global demand, is expected in the first quarter. This is due to the combined oil production growing faster than demand. OPEC Plus countries increased supplies in 2025, as well as exports from the USA, Brazil, Guyana, and other producers. Consequently, global stocks may start to rise, putting downward pressure on prices. Nevertheless, oil prices remain relatively stable for now. Since the beginning of the year, Brent quotes have risen by approximately 5 to 6%, partially due to geopolitical concerns. Brent is trading in the range of $60 to $65 per barrel, while WTI is around $55 to $60 per barrel, close to the levels at the end of 2025. Several risk factors are preventing the market from declining. At the beginning of January, the U.S. detained Venezuelan President Nicolas Maduro, calling on oil companies to invest in the country's production. In the short term, this caused disruptions in Venezuelan oil supplies. Additionally, Washington hinted at potential strikes against Iran's oil infrastructure, while Kazakhstan's production has declined due to technical issues and drone attacks on fields. These events create a geopolitical premium in oil prices and sustain investor interest. To maintain balance, OPEC Plus is adhering to a cautious strategy. The cartel and its allies, including Russia, decided to pause after a series of production increases. It has been agreed to maintain quotas without growth, at least until the end of March 2026. Major exporters seek to prevent market oversaturation. According to their estimates, fundamental market indicators are healthy. Commercial oil inventories remain relatively low, and the goal is to maintain price stability. If necessary, OPEC Plus reserves the right to adjustment production operationally, as both upwards, returning previously cut volumes of 1.65 million barrels per day, and to new cuts, should market conditions warrant it. Meanwhile, demand for oil is continuing to grow moderately. The global demand forecast for 2026 has been revised up to 0.9 to 1.0 million barrels per day increases, thanks to economic normalization and lower prices compared to last year. Overall, the oil market enters the year with a fragile balance. The expected surplus is mitigated by OPEC Plus actions and the threat of supply disruptions, keeping oil in a relatively narrow price range. Natural gas market, low inventories and high volatility. The global gas market at the start of 2026 is experiencing significant fluctuations, particularly in Europe. After a calm autumn when prices remained in a narrow range, 28 to 30 euros per MWh at the TTF hub, volatility returned in January. In the early weeks of the new year, gas prices in the EU sharply rose. On January 16th, quotes exceeded 37 euros per MWh. This was due to a combination of factors: forecasts of cold weather and the approach of severe frosts at the end of January increased demand, while the level of gas stocks was significantly below normal. By mid-January, European underground gas storage levels had fallen to around 50% of capacity, compared to 62% a year earlier and a 5-year average of 67% on the same date. This is the lowest filling level in recent years, after the crisis winter of 2021-22, and market participants realized that without active imports, Europe would face substantial depletion of reserves. Additional influences on gas prices included disruptions in liquefied natural gas supplies from the U.S. early in the year, caused by technical and weather factors, along with geopolitical risks, increased tensions surrounding Iran. Simultaneously, demand for LNG in Asia rose due to colder weather, intensifying competition for spot cargoes. Collectively, these factors prompted traders to close short positions, driving prices higher. However, by the end of January, the situation stabilized somewhat. After the passage of the initial cold spells, prices retreated to around €35 per MWh. Analysts note that volatility has returned to the EU gas market, although panic peaks like those seen in 2022 are not currently observed.
This was 24 Hours in America, our YouTube channel. Thank you for watching. Stay safe and healthy.